The economy feels like a house of cards, but while most investors are praying for a soft landing, you could be building a defensive fortress. Most portfolios crumble under market turbulence because they chase speculative hype. We're isolating stocks with rock-solid earnings and zero-leverage balance sheets to ensure you stay profitable while others lose everything. Think about how standard portfolios are constructed. Most people buy a broad market index fund like the S&P 500 or total market ETFs, assuming they are fully protected by diversification. But market capitalization-weighted indices carry a hidden structural flaw. As speculative mega-cap stocks trade at higher and higher multiples during market frenzies, they swallow up a larger percentage of the index. You end up heavily exposed to overpriced, high-beta companies right at the peak of the market cycle. When interest rates rise, inflation surges, or consumer demand shrinks, those exact companies suffer the most catastrophic price collapses. To build a true fortress around your wealth, you must shift from simple market cap weighting to factor investing. Specifically, we focus on two of the most empirically validated investment factors in financial history: low volatility and quality. Before we look at specific funds, let us address the brutal mathematical reality of market drawdowns. Portfolio losses do not scale in a straight line. They compound against you exponentially. If your portfolio drops 10%, you need an 11.1% gain to get back to even. If you drop 30%, you need a 42.9% return. And if you take a 50% loss, like millions did during the 2008 Great Financial Crisis, you need a massive 100% gain just to get back to where you started. The core objective of a defensive fortress is not to predict the exact month a recession starts. The objective is downside protection. By preventing massive drawdowns, your capital continues compounding from a much higher baseline, requiring far less market growth to achieve your financial goals. Let us examine the first pillar of our strategy, the low volatility factor. For decades, classical finance theory taught the capital asset pricing model, which claimed that higher risk is the only path to higher return. If you wanted bigger gains, you had to accept bigger market swings. But in 1972, financial researchers Robert Haugen and A. James Hines shattered that doctrine when they discovered the low volatility anomaly. Their extensive historical research revealed that portfolios consisting of stocks with lower price volatility and lower beta consistently generated risk-adjusted returns that rivaled or outperformed high volatility portfolios over long market cycles. Why does this anomaly exist? Because institutional asset managers are driven by quarterly performance metrics, causing them to chase high beta growth stocks in bull markets. This leaves quiet, stable, low volatility companies underpriced relative to their underlying fundamentals. Look at how this functions during real economic crises. During the 2008 financial crisis, when the broad S&P 500 plunged by nearly 57% top to bottom, low volatility strategies cushioned the impact dramatically, suffering drawdowns that were roughly 18 to 20 percentage points lighter. More recently, during the 2022 bear market driven by rapid rate hikes and record inflation, the S&P 500 fell over 18%, while tech benchmarks dropped nearly 30%. In that same period, dedicated low volatility ETFs held their ground, with some funds dropping under 5% for the entire year. That structural resilience turns market panic into your strategic advantage. Now let us bring in the second pillar, the quality factor. If low volatility protects you from price panics, quality protects you from operational failure. In 2013, economist Robert Novi-Marx published seminal research showing that gross profitability and high-quality balance sheets are powerful predictors of future stock performance. His work demonstrated that profitable firms systematically outperform unprofitable firms, even after controlling for traditional value metrics. This research was so impactful that Nobel laureate Eugene Fama and Kenneth French added profitability and investment factors to their foundational three-factor pricing model. What defines a high-quality asset? Premier index providers like MSCI and S&P Dow Jones measure quality through three primary financial metrics: Return on equity, financial leverage, and earnings stability. First, return on equity, or ROE. This measures how effectively management converts shareholder equity into net profit. High ROE indicates strong pricing power, wide competitive moats, and capital efficiency. Second, low financial leverage. This evaluates total debt relative to cash flows and equity. During periods of cheap money, low-quality companies can mask their operational weaknesses by borrowing heavily. But when a recession hits and credit markets freeze, interest expenses surge and debt maturities become fatal. Companies with low leverage and pristine cash reserves do not just survive recessions. They buy out distressed competitors and expand their market share at rock-bottom prices. Third, low earnings variability and low balance sheet accruals. This screens out companies using aggressive accounting tricks and ensures that reported net income is backed by actual physical free cash flow. When you combine low volatility and quality, you create a powerful synergistic effect. Pure low volatility portfolios can occasionally tilt toward high-depth, slow-growth defensive sectors like utilities. Pure quality portfolios can sometimes tilt toward expensive growth companies with higher price swings. By combining both factors, quality filters out low volatility debt traps, and low volatility smooths out the price swings of high-quality growth companies. So how do you build this in your brokerage account using liquid? For your low volatility allocation, you have two primary vehicles. The first is the iShares MSCI USA Min Vol Factor ETF, ticker USMV. USMV uses a sophisticated risk model to select stocks with low variance and low correlation to each other, while keeping sector weights within strict parameters to prevent sector bias. It charges a clean 15% expense ratio. The second option is the Invesco S&P 500 Low Volatility ETF, ticker SPLV, which selects the 100 least volatile stocks in the S&P 500 and weights them by inverse volatility. For your quality allocation, two industry-leading options stand out. The iShares MSCI USA Quality Factor ETF, ticker QUAL, targets broad U.S. companies with high return on equity, stable earnings growth, and low debt-to-equity ratios, charging 0.15%. Another top-tier fund is the Invesco S&P 500 Quality ETF, ticker SPHQ, which ranks S&P 500 companies based on return on equity, financial leverage, and accruals. To construct your portfolio, you can establish a simple core 50-50 split, 50% in your chosen low-volatility ETF, such as USMV, and 50% in your chosen quality ETF, such as QUAL. Historical data on multi-factor strategies reveals an incredible statistic. A combined quality and low volatility allocation historically captures roughly 75 to 80% of broad market upside during bull markets, but only 40 to 50% of market downside during crashes. This asymmetric capture ratio completely transforms your wealth trajectory. By participating in most of the market gains while cutting your losses in half during recessions, your long-term risk-adjusted return and Sharpe ratio expands significantly. You bypass the emotional panic that causes retail investors to sell at market bottoms, allowing you to stay compound-focused year after year. Managing this fortress requires very little time. Once per year, or whenever an asset class shifts more than 5% away from your target weights, you rebalance. If quality has outperformed low volatility over the preceding 12 months, you sell a small portion of quality to buy low volatility. This simple rule forces you to systematically sell high and buy low, stripping emotion out of your strategy entirely. Economic downturns and market pullbacks are unavoidable. You cannot predict the exact moment a market cycle ends, but you can dictate how your portfolio responds when it happens. By rejecting speculative hype and anchoring your investments in stable earnings, low debt, and low volatility, you ensure that market turbulence becomes a catalyst for long-term growth, rather than a threat to your financial security. Build your fortress, execute with discipline, and let factor investing compound your wealth through every economic season.